I see. Okay.
I'm broadcasting and starting to a couple minutes early to get it live.
Facebook Live?
Yeah, it takes
Alright.
a long time to integrate, so I'm gonna start doing that.
I'll be right back.
Yep.
Sure.
Choose your timeline. Share in a group. Okay. By the way,
No, just share it to your.
Mhm.
I think you can just share it on your Facebook wall. That way, more people can see it. Maybe.
Oh, on my own Facebook wall?
Yeah.
Oh, okay.
Like your timeline.
Oh,
Because
and
if someone is not in the group, they cannot see that. So
oh, that's
that's
true.
bigger reach. Yeah.
And then can you share the timeline so that the group can also see what happened?
I think so. I can do that sharing.
Okay, let me do that.
If you share it on your wall, then I can.
Okay,
Sorry,
yeah.
whatever it's called, timeline, right? Yeah.
Yeah, let me play with that. Still new to this thing.
Hey,
Hello,
And
can you hear me?
oh, hey, Yan. Yeah, we can hear you. Thanks for joining. I
Yan.
think, yeah.
This is the testing.
All right, it's people coming. All right, we'll be starting in a few more minutes. Yep. It's like Chris is here and Denise and a few familiar folks. We'll be probably starting in around 6:02 or 6:03. Just a couple minutes to join. Yeah, I'm happy everybody can join us. I think Boek is going to make it as well. It's great.
Hey, Henry, I'm here.
Oh, hey, Boek. Speaking of devil, just kidding. Thanks for joining us. Hope you're feeling better.
Yeah, thank you. Yeah, much better now.
Here, glad to hear.
That's good to hear, Bovik. Welcome.
Thank you, thank you.
I was actually in a hospital today for an appointment, and it was kind of spooky in some way because it was pretty much deserted, and I felt a taste of what other countries are doing because they like measured your temperature and they're like, oh, hey, do you have any fever symptoms? And asking me all these questions. I'm like, oh my gosh, I'm just here to like do a serious appointment. But yeah, I mean, it's good that they're doing that, but it's just like, wow, this is it kind of hits real when it happens to you.
Oh yeah, absolutely.
Yeah, good thing my temperature is normally below what it's supposed to be anyway, so there's it's even more sure that I don't have it. So.
Well, ice your forehead before you go in.
Yeah, try to get me now.
That's right.
Yeah. Actually, it's Sam here in Seattle. You know, a few days ago, I went to urgent care. They actually have a nurse outside of the urgent care, check my temperature and ask a lot of questions before allowing me to enter the urgent care. So they also they give me after that they give me a special label put on my shoulder saying that it's already checked.
Mm-hmm. Let's see. Also, my Facebook Live is giving me a hiccup. It's not doing what it's supposed to. Technology. Well, we still got a couple minutes. Let's see if I can just refresh my windows and see if that helps. By the way, if you're here already, let us know where you're calling from. I am. Oh, James, you plan on starting us off with the meeting?
Yeah, absolutely.
Great. Awesome.
Yeah,
Thank you.
Wait another minute or two.
Yep.
Well, I guess it's a little bit depending on Facebook, so whenever that gets up. So.
Yeah, I mean, if let's see if I can stop and try it again, but we still got another minute or two.
Yeah, it seems like it went somewhat smoothly last time. So.
Mm-hmm. Yep. Let's see if I can. Or I wonder if I have to accept it being on my timeline. Let's see. There's if not able to live stream, I'm just gonna put up the recording on the Facebook page so everybody can see it. Yeah, later afterward.
Sure, that sounds good. Yeah, I think we can get started.
Yeah, it's kind of stuck. Just give me a black screen. So we'll be starting in 1 more minute.
Yeah, worst comes to worst, we'll just have to post the recording.
Yep. All right, James, want to get us going?
Sure. Yeah, let's get the roundup started. So, thank you everyone for coming to attend with our 7th Coast-to-Coast meetup, but it's our 3rd in our little mini series that we're calling the webinar roundup, where we, as a collective group, we dissect, analyze, and offer our unique perspectives on what industry experts are seeing on the impact of COVID-19. And its impact on both real estate and the economy at large. And we're a collection of practicing and active investors that hail from across the country, hence the name Coast to Coast. And these are some of the cities that are represented by this panel: Seattle, San Jose, New York City, etc. And this is a time for us to share a knowledge, what we've been seeing, because we are always on top of industry news, and we love to share that with whoever may be listening to our audience as well, so that they can likewise be informed and that they can best prepare their investment strategies. So on the next slide. So a little bit of context, most, if not all, I believe, of the panelists are graduates of the boot camp training from Neil Bawa, which I believe all of us took it last year. And this was a boot camp that we learned much of the processes that we implement in our active day-to-day investing. And it's really why one of the reasons that a lot of us are here today as well, just to connect and share. And it's actually where I met some of my business partners and really just friends as well. So he is very much active in much the same space of educating as well. He calls himself an educator first and investor second. So he actually had 2 webinars last week. One was on the town hall, which we'll be talking about later. And also the first in his location magic workshop, which I think is just fantastic. It really provides a data-backed and data-focused way to say, hey, what market should I invest in? Well, let's look at the data. And he tells you all about how to do that in a very action-packed way. And he's actually having another webinar today as well with a guest speaker as well. So it's really pretty much every week he has some topic or expert coming on. So he's definitely along the same mindset of us, of really just staying on top of the industry and really sharing it with his audience and fellow investors. So next slide, this is the most recent town hall, number 5. You can see how many he's done over the last few weeks. But here is some familiar faces to all of us on the panel. We, at least I know these 2 individuals, Jay Scott and Ferris Musa, personally. And yeah, it's just action-packed, and we'll be disseminating some of the great takeaways that we got from that content. I believe Peter will be delivering that shortly. And on the next slide, we'll be seeing the friendly faces of the panelists today. Henry, we'll give a brief introduction to each of the panelists. I'm in the bottom right corner, so it seems a little bit out of order. So why don't we start with Henry in the very top?
All right. Hello, I'm Henry again from Seattle, and the father of 2 kiddos. I am a daytime aerospace engineer and full-time real estate investor. Got a small portfolio of single-family rentals and finished several fix and flip and development projects. And last year, I just began to shift my focus to multifamily and commercial real estate because of the cash flow, the tax write-off, and the hedge for inflation. And he's now it's coming. So I'm now just working in several partnerships, several of them here, and to acquire our next project. So happy to join the call.
Wonderful. And yeah, we'll go clockwise as we usually do. So Jan, how about you introduce yourself?
Hi, my name is Yan from New York. I'm also a multifamily investor. In my day job, I work as a risk manager for the hedge fund. So I would like to use my quantitative skills and analytic skills into a real estate investment.
Wonderful. Yeah, Chuck wouldn't be able to join us today. He's actually a practicing dentist, so he sees patients pretty much around the clock, especially nowadays. So, but I myself, I'm based in the Los Angeles and Orange County area of Southern California. I am a full-time policy writer for air pollution control, as well as a business owner for a Houston-based chemical engineering company. But real estate-wise, I got started about 3 years ago, and with a heavy focus on specifically multifamily acquisitions and syndication about a year ago now. Actively looking across the country for value-add projects and soon to be new construction as well. And very happy to share information and really connecting with everybody here. And we'll swing all around to Peter.
Hi, Peter Pomeroy, San Francisco Bay Area. I'm full-time in real estate and have been for the past 20 years or so in a whole range of capacities from brokerage to investment, development, construction. And I think many of these folks connected through Neil's boot camp, which is terrific. And so glad to be here and presenting and getting to know everyone.
Wonderful. Vijay, how about you introduce yourself?
Hi, my name is Vijay Kim. I'm a physician from Los Angeles, and I've been interested in real estate for the past 4 or 5 years. But in Costa where I lend money to rehabbers who rehab projects. But for the past 1 year, I've been really focused on multifamily. And I love these meetings. I love meeting all these people because there's so much to learn. And I want everybody to learn along this journey.
Wonderful, yeah. And Bowick, since we're covered, let's hear from you.
Okay, hi, this is Bowick, Bellevue, Washington. So I'm a certified real estate instructor and working in title company. So basically I provide a lot of training to my real estate agents. So that's me.
Great. And last but certainly not least, Vivek Garza.
Hey, James. Hi, everyone. This is Vivek Garza from San Jose. I'm a data engineer and real estate investor. I have a bunch of single family homes in Kansas City, Missouri. Started about 2 years back. Met a lot of wonderful people in the boot camp and also through the network of real estate. Currently focused on multifamily deals and expecting to see some good ones later this year.
Absolutely. Yeah, and if you didn't catch any of that or all of it on the next slide, you can see all of our contact information. So feel free to reach out to us. We'll be happy to have a virtual coffee or even just a phone call. And we recently started a Facebook group as well, where you can connect with other members as well and ask questions and really just kind of share knowledge or just really build a community of investors so that we can all learn and grow together.
Virtual beer also.
I'm sorry?
Virtual beer.
Yeah, the best kind. So this is the game plan for today. We're going to be breaking up into 2 sections. One's going to be more of a macro perspective on the economy, what it's going to be looking like opening up and kind of what the current status is, as well as kind of the Town Hall 5, which I mentioned earlier with Neil and Anna Myers. And then we'll be delving into the specific industry of real estate, looking at a few big associations and organizations, Yardi, RealPage, and a much anticipated Berkshire Hathaway annual meeting as well. So with that being said, let's dive into the economy and what the current projections, which seem to always be changing, but let's see what the current data is showing right now. And Henry will take it away with that.
Yeah, sure. Let's talk about the new COVID cases in the US. I'm a paid subscriber to the Hedge Eye, which is an investment research firm. And they are also one of the first company that I know that called the stock market recession entering January 2020. So they publish the COVID data weekly every Thursday. And so on the left here, you can see the daily new cases. And on the right is a chart of the daily deaths. We see a kind of a gradual flattening of the curve as new cases has dropped from 25,000 cases in May 6 to, I think just before coming in, I checked, it was about 18,000. So it's definitely flattening, and daily deaths is also gradually dropping from 2,500 to about just 1,150 today. So I think that's good news. But there's, compared to other developed nations such as Italy, France, Spain, US daily cases still really high. I think one reason is that we have a high mobility. This mobility data has come from Google. We see European countries are essentially in lockdown mode and just decreased mobility to 70 to 80% from February's number. But in the US, we have dropped slightly, only to about 40% range. And we just left a park, so you can see in the middle there. So I'll show you the next chart. These two charts show changes in mobility versus changes in cases. The red is for cases and the blue is mobility. So you can see the left chart shows no lag, where the right shows a 12-day lag. So essentially we move the red line 12 days to the left, so you can see a better causation and relationship between the two. We also see that in mid-April, Americans or people in the US are moving again with an uptick in mobility of around 10%, but the daily cases still stays fairly low. So I think one reason is that New York has basically have the cases under control. So the question is, how does the opening of America affect future projections? By the way, if you have any questions, feel free to drop it in the chat box or Q&A box, and we can talk more from there. And the next chart is really talking about projection model. And this one comes from the Washington University, and is often cited by the White House Coronavirus Task Force. And this model has been recently revised. So on the left there, you can see in the smaller table, on the smaller chart, on April 13, the daily death was projected to hit 0 by June. And in the latest or recent update, the Washington University is projecting 1,000 cases in June. So there's a much longer tail. And the change is basically of a change to following the social distancing guidelines, or basically opening up America, have increased mobility and all of that. I'm going to show you another chart. This one is for the total deaths. And Washington University also estimated about 100,000 cases of death, which is above the initial goalpost or gauge on how well Trump thinks he does to control the pandemic. So in conclusion, the fight is not yet over, even though we're flattening the curve, and but then we still require fairly strict social distancing, or we're going to start seeing these higher numbers even past June. And so that will have an impact to businesses across America and our economy. So with that, I'm going to turn it over to Peter to talk about what he learned about this Town Hall 5.
Hey, Henry, I've got a question.
Yeah.
And did you have a number that showed how many deaths would be occurring at that kind of August 14th time period? So I see on August 4th that we're at 134,000 plus deaths total. Do we know what the total, I guess it's terrible to say, but daily death rate is at that point in time?
I don't have that number, but I think I can find that from Washington University.
Yeah, those are great graphs. Anyway, all right. Okay, so we can go up to, here we are. So
just one thing to add, Peter, to answer your question. So basically the daily death increase is just the slope of the yellow part, right? So you can see that April 4th should be really flat, meaning that the daily death increase is not, it should be very small.
Yeah, so I was wondering about what its like rate of decline might be. Like, but let's save that for another conversation. Like, I wonder if the kind of rate of decline starts to slow as well. But
And it should, yes.
yeah,
It's just a longer tail than the initial projection.
and that's what I'm responding to. So I mean, those are great illustrations, and they kind of factor into the real estate component and the economy component, obviously, and I'm not sure anybody knows entirely how that it will factor, but with that, we can go to my piece, which touches on some of that. So, so this was the Town Hall 5. It was a 2-hour webinar, a lot of good content. What I've tried to do is, and I'm not watching my time to see how close I get, is reduce 2 hours into 5 minutes, which if anybody who knows me will know that that's nearly impossible. And so just to get into it, I'm going to hit on, these 4 bullets here: the economy, a fun Main Street opportunity, touch on some product types, and give some final thoughts. So we can go to the next one. Okay, so the economy, which is a big one here. A couple things, and we've touched on this in some of our past webinars, but truthfully, before January 1st, 2020, the consumer debt, corporate debt, was at a massive high, and some of that debt was good, but I don't think too much of it. Manufacturing was struggling, retail was showing signs of struggle, and then importantly, interest rates were at close to zero, and what that means is that there was very little leeway or runway for the Fed to kind of spur the economy. So we were set up for trouble, and looking for a trigger, and that trigger, of course, was COVID. Jace, and that was Neil's comment. Jay Scott, whose background, well, he's got all these guys have, seem to have backgrounds in technology and then move into real estate. Not all of them, but nonetheless, economics and real estate. Made a good point here. He said, basically, recessions and cycles are healthy. They happen every 6 years, plus or minus. They've been doing that for a long time. One can think of them as kind of cleanses that get rid of a lot of debt primarily, and then lead to sustained and healthy economic growth. That's kind of like the positive way of putting it. In terms of the recovery, there's just tons of debate, and over a 2-hour call with the webinar with them, there's movement even within the speakers in terms of what they think, and that's fair because they're trying to figure this out like everybody. But the net is that the V-shaped recovery where we drop down and bounce up, I think that's not gonna happen. And the thought is that it'll be more like a Nike swoosh, and the recovery could be 2 years. That was Neil's thought, but we're not really going to know for 3 to 6 months. There was a good kind of analysis or set of ratios related to the lost jobs. So, just assuming, 33 million jobs are lost, and that's not a current number, some percentage of those jobs are gone forever and don't come back. And then, some percentage, say 20 to 30, will take years to return. And to assume that our innovative our innovative country will grow those jobs as new jobs, that's a lot. That's a big ask. And Neil was talking about, and at the time I was like flabbergasted that the government may need to pump into the economy up to $10 trillion. Now, if you note the comment, my comment above, where there's not a lot of leeway for the Fed to stimulate the economy, that's kind of may seem contradictory, but then I was thinking about how in previous depressions and recessions, our country, sometimes it goes to war to, generate GDP, or it starts to do massive infrastructure projects. So hopefully not the former, but perhaps the latter. And so just to consider is, assuming that the Fed's ability to stimulate growth may be limited, and that the recovery may be, 24 months, how will that impact particularly multifamily and single family over the next 12 to 24 months? And especially as you will see how they view multifamily and single families drop and bounce back. So with that, we can go to the next one. This was kind of an aside, but I think it's an important one, especially if there's people on here, people we know, or just frankly ourselves, and who want to get into, who want to benefit from, the economic state of affairs. And this was Jay Scott's kind of concept, and he basically was saying that for this recession, the real opportunity may be in small business ownership. And in 2008, just like in 2008, the opportunity was to buy real estate at significantly discounted prices. And the reason for that is as we know, there's millions and millions and millions of small businesses. It's generally illiquid, and the kind of toll that this is taking on small businesses is going to allow people to buy pennies on the dollar. And then, of course, if you're buying a small business, you want to make sure that it's recession resistant, or an essential business. And, you can think through that. And they gave a lot of discussion on that. So we can move to the next one. Okay, so now we're going to talk about products here. So multifamily, it's kind of interesting. I think it's very interesting. So, in recessions, typically there's this like tenant migration from A to B to C classes, nice to medium to kind of poor. And wasn't really any indication that that's happening yet. I think it's just kind of too early. Similarly, class A rents tend to take a bigger hit than class B. But the data out there indicates that the drops in rents are really negligible. So we'll see how that plays out. The values, so there's a kind of general agreement that multifamily might drop 10%, but the drops were primarily due to lender requirements on principal and interest, that being 12 months, versus tenant defaults, et cetera, because frankly, all the people on the calls, no one was getting, in terms of their collections, less than 90%. Most were, in the high 90s and somewhere at 100. So that's, I think, really interesting. As it relates to tenant retention, just tons of conversation about workout strategies. I forget if it was on this call or another call, but when I was a commercial broker, we used to do, when there was a recession, a lot of blend and extends, where, we'd take a tenant that had 2 years left on their term and add 3 years and modify their rent. And in a really bad recession, sometimes in office buildings, I did a deal where a tenant, large tenant, their first year, all they were paying was operating expenses, which, was a benefit to the building owner. So, they're seeing a lot of that. They're doing a lot of that. Okay. So then single family homes, like kind of the consensus again was maybe 5%. Jay Scott, who's done like, I think he's done like 500 single family homes, flips and a portfolio. I mean, really extensive. His comment was, it's a bad time to flip. And if you're asking the question, you shouldn't be doing a flip at all. But if you're going to do a flip, what you should do for your locality is, figure out how much single family homes dropped in 2008 and then build that into your margin, your profit margin. But then what I thought was really interesting is the quote, at the bottom here, where basically, you know, and he, you know, Jay's a really smart guy, and I haven't had too much exposure to him, but bottom line is, he's basically saying that, you know, anyone who tells you they can predict what's going to happen is just making stuff up. So my guess is no better than anybody else's. So, you know, wonderful honesty and transparency. Other products, self-storage. So historically, when people start to downsize, they keep their stuff, which drives self-storage demand. Of course, we're not seeing people downsize yet. Retail, and you know, I couldn't get the spirit of this, but they said, you know, obviously if you're going to do retail, you want grocery anchored. Personally, I think it would be really hard to raise capital for a retail center. Industrial with logistics, this is big one. And Neil had a great data point, which is that we've been basically in a just-in-time economy with 4 days of reserves, and we're now going to need to move to a 14-day of reserves economy. And a data point I have from a thought leader is that the U.S. is going to need 1 billion of industrial, 1 billion square feet of industrial. So, you know, either way, that's a lot of need for industrial. And then, of course, the product innovations, which I love, where you take a motel and you convert it to senior housing. I think you could do student housing probably. I think you might even be able to do apartments, office to medical office, multifamily or other, malls too. And I just have those dots because, you know, since 2007, people have been talking about what to do with malls. And, you know, I'm sure there's all sorts of other product innovations that are out there. Okay. So, you know, final thoughts, you know, their final thoughts are, you know, it's a great time to, to build or join a team. My add-on to that is, you know, depending on where you live, you can be a boots on the ground, and that's of great value. You'll hear frequently, you know, keep your powder dry, which basically means, you know, try to get as much cash available to buy something, because prices will drop. And then, you know, kind of, I think summing a lot of this up is that, you know, yeah, real estate's always been local, but I think now it's becoming, you know, even more hyper local. And that's where like a boots on the ground becomes important. Someone, you know, knowing the block and the half block and all that kind of stuff, and the building and its relationship to the other buildings, like that becomes really, really important, especially in a you know, distressed market, distressed economy, etc. So with that, I am done.
Thanks, Peter.
Yeah.
All right, Vivek.
Hey, Andrew, yeah, thanks.
Oh, there's a page there.
Yeah, I can see my slides. Sure.
Great.
Can you guys hear me?
Yep.
Yeah.
Yeah. So this was the Yardi Matrix presentation, I think last week. So Yardi put out this extremely bearish message. The pain has just started. What does that mean? They see about 33.5 million jobs lost. This is record levels of unemployment in the last 6 weeks. The sectors that have been most impacted are obviously travel, non-essential services, and more recently oil and the whole energy sector. GDP, which is the indicator of economic growth, that's contracted by about 5% in the first quarter of 2020. The current quarter, which is the second quarter of 2020, is expected to be the worst since the Great Depression. Not the Great Recession, but the Great Depression. What we are seeing is that it's extremely hard to kickstart a $22 trillion US economy. We are seeing a lot of stimulus and all of that, but it's becoming a tough task. Next slide, please. There is some good news, by the way. There's a lot of stimulus from the federal government and also the Federal Reserve. There've been literally trillions of dollars in stimulus pumped into the economy. Not surprisingly, the stock market has erased most of its losses, although the economy seems to be just about starting to go south. The recovery is going to be very gradual, not a V like most had predicted earlier. It's going to be partial and it's going to be very slow. A portion of the workforce is going to be idle for a good amount of time. What we are seeing is we are seeing ripple effects run through the economy, meaning job unemployment leading to more jobless claims, leading to defaults and so on, which we'll cover in the next few slides. Overall, multifamily collections have been looking really positive. Tenants paying on time is the one thing that multifamily asset classes depend on. They've been turning out much better than expected. Let's take a look at how different classes performed. I think Peter covered a little bit in his slides, but just want to cover what Yardi had to say. Class A is usually the highest rented places in a city or a submarket. Those have had the best collection so far. Class B is somewhere in the middle. Class C as in Charlie, which is mostly catering to the service industry and hourly workers, that's seen a little bit of a collection issue. But some trends are beginning to emerge within the multifamily collections. For instance, smaller floor plans are less desirable nowadays, possibly because people need more room when they're stuck for 24 hours a day. Corporate and short-term rentals, especially Airbnbs, VRBOs, they are struggling quite a bit. Landlords who have had high exposure to these are seeing major revenue hits. And in this next slide, we'll see how different parts of the US have been taking this collection. Next slide, please. So across the US, you see different economies behave differently. As Peter rightly said, it's very hyperlocal. Some of them which are exposed to more government, technology, and healthcare jobs, they've been doing much better. The bright red spots that you see on this map are mostly Vegas, Orlando, Miami, some places in Louisiana. All of these are heavy tourist markets, which have pretty much obviously been hit by this pandemic because people are just not traveling. You see a few red spots along the West Texas and the Houston, which is the southeast part of Texas. Those markets are bound to lose some jobs because of the oil price collapse. In general, economies with a good mix of jobs across sectors will likely weather the storm much better. Yardi Matrix is also a very good resource for rent growth projections. That's precisely why a lot of operators use this resource. And in the next slide, we'll see some significant revisions to their rent growth predictions in certain markets. So overall, when the year started out, Yardi's rent growth was kind of positive across the board, but now the outlook seems more cautious for 2020, with a slight bit of recovery happening in 2021. Even though these are initial estimates and are changing frequently, we can definitely identify some trends. Some of the biggest revisions we see are markets like Las Vegas, Miami, Orlando. These are all projected to have negative rent growth this year. Houston has had low rent growth for over the last 2 years and will likely continue to see a modest rent increase. But I think the oil market there is going to have a severe impact. In the next few slides, I want to take a little bit of a different approach and see how the ripple effects of the economy or the pandemic, ripple effects of the pandemic percolate through the economy and try to see if we can identify what a good time to buy is. So this is a slide where you see a picture of Ken McElroy. He's one of the Rich Dad Poor Dad advisors with Robert Kiyosaki. He recently put up a very good analysis of how the shock of COVID-19 can literally ripple through the economy. It's interesting how he compares each aspect of the economy to ripples on the water. So imagine you have a glass of water which is still, and all of a sudden a pebble just falls into the center of the glass. And in this case, the pebble is the coronavirus pandemic. The ripples which go outward at different time instances is usually how different aspects of the economy get hit at different points in time. Similarly, we see different aspects of the economy try to behave differently, but not at the same time. Next slide, please. So we've already taken a look at how the pandemic is evolving. I think Henry had a few slides. Now let's take a look at unemployment. We've never seen this scale of job losses. I think this chart shows you clearly how in the last 40 or 50 years rather, this is just an unprecedented event which has caused more than 30 million jobs lost. This number peaked towards the end of March, steady drop, but last week's numbers were still close to 3 million jobs lost. To see some kind of normalcy, we would want to see significant reduction in this number before we can even try to speculate if the economy can get better. Next slide. So let's talk about a little bit about the stimulus. The Fed now has about $9 trillion on its balance sheet. This is a combination of buying out troubled assets, mortgage-backed securities, and bonds. This is more than double the number before the pandemic. The hope from the Federal Reserve is that this will stimulate the economy, but any outside intervention into the economy takes its time to trickle through the system. The positive here is there is a lot of stimulus both from the government point of view and from the Fed, which is kind of keeping the economy chugged along. But the question is whether this is enough. And I think Peter covered in one of his slides that we will likely require a lot more stimulus from the government, both to businesses and individuals. Let's take a look at the loan default data in the next slide. So this is one of the slides that investors really like looking into to see how different asset classes are performing. This chart shows you loan defaults, which happen when a borrower is unable to make their loan payments, which is usually a sign of declining business. From March to April, just in 1 month, there was a massive spike of late payments for commercial loans. This is technically not a default yet, but a good indication of how different sectors are doing. Almost 20% or 1/5 of the loans in the lodging sector, of which hotels are a major part, were 30 days, at most late by 30 days. Retail, which is in the light brown shade just below the red spike, is also seeing some pain. Multifamily is seeing a little bit of an uptick, but it's one of the better classes right now. There is no slide, unfortunately, on when the best time to buy is. As we all know, nobody can predict that. But what we can do is keeping a close eye on all of these metrics, which is unemployment, stimulus, loan defaults, and how the overall economy is recovering. And not to forget GDP. I think keeping an eye and a pulse on all of these will give you a good idea of what that time might be.
This is a great slide.
Yeah, Vivek, I'm curious why the office is so low relatively to the other sectors.
I think maybe it's probably because they might be well capitalized and most corporations haven't stopped paying rents yet. But if we see trends that most people are okay working from home and leases get not renewed, then we might see a different scenario, say 6 to 12 months later.
Yeah, good point.
So let's conclude. So what Yardi has to say is multifamily has and is likely to perform better than office, industrial, and retail. That's Yardi's take. There are other asset classes like self-storage and mobile home parks, which could do better than multifamily. What I found interesting in this slide is certain trends that have accelerated and potentially reversed because of the coronavirus. One thing we all know is e-commerce is just taken off the charts. Everyone is ordering online these days. They're fearful of going to a store. Virtualization, the fact that we're doing a webinar and a meetup online right now says a lot. There are certain cities and municipalities which might be facing bankruptcies and political risks, and also the possibility of high taxes because of all the capital stimulus that is coming in. The potential reversal of certain trends is also likely to take place. People are more, the younger folks were more, they liked experiences over things. That might reverse now because travel has reduced. Dense housing in urban areas might reduce because people want to be apart given the social distancing norms. And globalization with all the trade war and everything, that might see a little bit of a resistance going forward. That's pretty much what I had with the slides with Yardi Matrix. Thanks a lot, all of you.
Thank you for sharing. Yeah. And Zoom just took off like crazy in stock prices.
I know.
Awesome. Oh, looks like you still got a couple of slides to talk about.
Oh, sorry. I didn't think that there was another slide, but yeah, that slide just summarizes all of the things that I just said. Maybe Pooja can take over.
Okay. All right. Yeah, let's start with.
Sorry.
There we go. There we go. Yeah. So I listened to. Can you guys hear me?
Yep.
Yeah, we can hear you, Pooja.
So I listened to Co-Star webinar, and there are so many very interesting graphs. So my talks is gonna be all about graphs and explaining what they represent. So let's start with the GDP trend. This is the GDP trend for the past 10 years. Orange line is a trend based on data up until 2019, and is projected growth if COVID did not happen. And then the blue line is a real GDP. So currently there's in 2020, there's a dip, but they say that in second half, they'll probably see the trend go back up. Probably it's currently a lot of businesses are closed, but as more business starts to reopen, GDP has to go up. However, it'll be a while before GDP catches up with the original trend line. Next slide. And GDP is, so employment rate is very important because GDP is is interlinked with the employment rate. So obviously a better employment rate, the higher GDP will go. And this data shows employment data going back 50 years, okay? There have been 5 major recessions in that time. And each recession, it took about 2 to 4 years on average to return to the previous levels of employment. And one interesting thing is if you look at it as a whole, you kind of see that the record time is kind of getting longer. Initially it was 21, 28, 32, 48, and 76. So the last recession in 2008, it took about 6 years to recover the employment rate. So we can expect that with the current crisis, it may actually take a little bit longer. Okay, next slide. Now, this is consumer sentiment. Consumer sentiment is one of the economic indicators of overall health of the economy. So basically, it takes into account an individual's feeling towards his or her current financial health. So if people are less confident about their financial health right now, they are less likely to spend and they will save more. So as you can see on the graph on the left side, in 08, 09, you see a big drop, right? And it took a while for it to slowly climb up, but again, in 2020, it's dropping down again. The graph on the right shows total checkable deposits. So basically it means you can think of this as how much people are saving. And for the past month in April, the saving rate has been going up. So, the more people save, they are spending less to stimulate the economy. So it's kind of paradoxical. Saving is good for an individual, but not necessary for the economy. Next slide. Yeah, this is looking at the a survey result of people's expected behavior post-COVID. Okay, so they looked at how people's intent would change after COVID. So there's a trend that people will continue to avoid going to malls, going to movie theaters, or traveling. So there will be overall kind of decline in retail and travel related activities. A lot of people will continue to stay home. I mean, I think they want to go out to actual physical groceries more because, understandably they're kind of really tired of online grocery shopping. So that will go back up. But a lot of this behavior change will likely to continue for some time in the post-COVID world. Next slide. Now, these graphs show metros with percentage of workforce that are working from home. Okay. So on the left are metros that are better positioned to work from home. So anywhere from 5 to 10% of the workforce in these cities are able to work from home, okay? And a lot of these areas include many tech job related areas like Raleigh and Austin at the top. So the trend of working from home will likely just increase in the future. And then a lot of it will remain permanent. And they say actually about half of US occupation has potential to be converted to home working to some degree. And as more people choose to stay home, like potentially there may be more, there may be a boom in the suburban housing market. So those are some of the things that we may need to be aware of. And on the right side of the graph are the bottom 15 markets. So, like hospitality driven markets such as Las Vegas are among the top there. Next slide. I cannot, hold on.
I think we need to go back to sharing the screen, Henry.
Yeah. Hello? Can you guys see my slide right now?
No, I cannot. It's coming back on.
Okay, I think somehow it got kicked off. Okay.
Next slide. And next. Okay. This is actually a very interesting graph looking at how many of the workers are commuting and using public transit in different metros. So on the x-axis is a share of workers using public transit, okay? And then on the y-axis are the percentage share of workers with more than 60 minutes of commuting time. On the far right is New York, which has the highest percentage of workers who are using public transit. And a lot of them are commuting for more than 60 minutes, more than an hour, okay? And then others followed by San Francisco, DC, and Boston. So, so these cities, such cities with long commutes will kind of see a lot of changes as workers will kind of demand more ability to work from home, okay? Next slide. And on this graph, this is a percentage income loss. So, on the x-axis, it represents different income levels. So the far left is income level of less than 25K and goes to income level over 200K. And on the y-axis, the percentage of people who are experiencing income loss. So for example, on the far left, less than 25K, 70% of that population had experienced some type of income loss. And then the income loss percentage kind of drops as the salary increases to the right. And then the sky blue bar in the middle is a percentage of people who couldn't pay the April rent, okay? And as expected, people in the low income group had more difficulty paying rent, and it kind of gradually goes, decreases to the right. But what we see is that overall, everybody's affected to some degree, right? I mean, government help is good, but it is not going to be permanent. So they say they hint that there's a little bit of like a general sentiment, an increase in desire and openness to move. And when people move, people are gonna either consider paying less or equal rent. So they're not looking to upgrade. So they're expecting to downgrade when they move. Next. So let's see how this trend may impact the multifamily class assets. So this is a chart of rent growth for 2020 based on the data gathered by Coast-2-Coast. So if you look at it before March, the rent growth rate was positive, so it was above the 0.0. But starting March, after March, everything became kind of negative. Now, one thing is, even though the graph, it looks like a big difference, but if you look at it, it's the percentage change 0.0 to 0.2 to 0.4. So it actually not that much, but they're just showing like a relationship, like a trend, okay? So, and then Coast-2-Coast, they use a different rating system. They use a star system like Yelp, so 5 is best and 1 is the worst. So the gray line represents class A, and then B is orange line is class B, and then blue line is class C. So based on this, the relationships, class A rent drop was greater than any other classes. And this kind of shows a sentiment that not many people think this is time to upgrade, and then the trend is to kind of downgrade. Next slide. And this is my last slide, and this is basically showing which cities are kind of popular right now. This is based on apartments.com. They analyze people's search pattern. So x-axis is searches for other markets. So from your market to looking at other markets. And on the y-axis on the left side is changes in searches from other markets looking into your market, okay? So let's choose Cleveland as your city, on the far right. So for people in Cleveland, there was a 45% increase in search pattern for outside Cleveland, okay? So a lot of people in Cleveland were looking outside Cleveland, but on the y-axis is 0%, which means that not that many were looking into Cleveland. So you can say that Cleveland was not really popular. Now let's go to the other side on the far left. There's Austin, San Diego, Raleigh. So more in these cities, more people from outside were looking into these markets. And those who are living in these cities, they are looking less outside this market. So presumably they're kind of happy with what's going on in these cities. And I mean, Austin, San Diego, Raleigh, they're technology and biotech driven cities. So these cities were kind of popular before, but with the current COVID situation, the trend is likely to increase. Okay, that's it. Thank you.
Thanks. Yeah, this is a good chart. This is probably show where we could look for a new next target for acquisition. So,
sure. Yeah.
Yeah. Thank you. James?
Great. Yeah, I'll talk about RealPage. They had a relatively shorter webinar talking with 2 people this past week. And so a little bit of background. RealPage is a software and data analytics company for operating your asset and kind of managing the operations and all the data that's associated with that. So as you see the trend here, there's a lot of data focused organizations giving these talks. So we're talking with the top of the industry really for these informational bits. So they actually interviewed 2 individuals. The first of which was Alliance Capital's Brian Cribbins, who is the head of the management arm of Alliance Capital. And Alliance Capital is actually a huge company. They own or manage 134,000 apartment units while investing nearly 10 billion with a B dollars and managing 20 billion of other people's assets. So really a conglomerate of sorts. So that to say he has a little bit of insight into on a pulse, so to speak, on the market. So, but just a little bit of insight into kind of what his best practices are. And this was a little bit earlier on in sort of the late March timeframe, is kind of ensuring the primary focus, safety first, and so prioritizing safety and the continuity of the business operations, even though they couldn't really do anything or as much in person, which included virtual tours for new leasing traffic, as well as what I thought was really interesting, do-it-yourself repairs, where prioritizing more so urgent orders rather than emergency orders, and having the tenant FaceTime. It sounds kind of crazy, FaceTiming with the maintenance staff and addressing the issue kind of right then and there, which is a pretty interesting take. And I'm curious if other operators adopt that same change. And he actually created, him and his team, they created 300 pages worth of changes to their SOP, standard operating procedures, within the span of a week. So that he was very proud of his team for that. So which may be indicative of just other operators across the country changing their operating practices as well. So for both of these interviews, they kind of really focused on two things. One is collections as well as leasing. I know we talked about collections a bit with Vivek's presentation. So with those 134,000 apartment units spread across the country, here is what Brad is seeing. Nationwide, he is seeing about a 95% collection rate, but that's average. So he's seen a higher than that in the central kind of interior of the country, as well as the northwest part. However, sort of at or below that, he's seen on sort of the diagonals, I call it, the Southern California and the Northeast. And what he said the challenge was, you know, where I live, Southern California, there's always a problem there. So, but he said it was hardest hit due to, and really hard to keep track of, because every municipality in Southern California has their own kind of regulations regarding eviction moratoriums or just other, should I say, business unfriendly, or really just regulations that dictate how an operator or landlord needs to really operate the property and or treat the tenants as well. So, but another bit was that it's actually one of the more lenient areas in terms of favoring the resident side, as Californians want to do, where in some cases, in some municipalities, they're allowing up to 12 months for residents to pay back deferred rents, so with that allowance, it really disincentivizes residents going on to a payment plan, where they sort of have a plan in place in agreement with the landlord to pay a percentage over time. So what Brad is instituting in his payment plan, and it's kind of just a standard, and he emphasized more than once that it's a very individualized, as in every single person, plans, speaking to them, communication. On our first webinar, my main message for all the audience was, it was just communication with your lenders, with your tenants. So his communication with his tenants is the standard plan is a 50% down for the month, and then paying the remaining 50% over the course of the next 2 months, and then modifying from there as the situation dictates. So in terms of leasing, he did see quite a spike in online traffic, which is understandable, but overall the traffic is a bit down, which is understandable, but it's more resilient than he had anticipated. And as part of that communication effort, he instituted a sort of a messaging campaign of speaking to the tenants, having the property manager reaching out and posting messages on the bulletin boards or the online forums, as well as creating a hotline where residents can at any time call and ask questions about payment plans or what have you. So, but he's actually not seen too much. I don't think I wrote the number down, but I believe it was 3 to 4. Oh yes, I did right here. Only 3 to 4 percent of his residents have actually asked for a deferral, which I thought was interesting. So with that messaging communication, it just to show how far that really goes with people to feel like they're heard and understood, is his typical operating rating from his residents is about 4.1 to 4.4 stars out of 5. But after this campaign, his incoming ratings are about 4.5, which, you know, of course, of the 134,000 apartments, 0.1 is a pretty big deal. And that's actually the highest in their industry, in their history. And I believe they've been operating since 2004. So kind of similarly with the next guest on the webinar on the next slide was CF Real Estate Services Sharon Hatfield, who is the COO. Again, a huge company. They offer a lot of operational consulting services, financial auditing, contract management, construction management, all these things. So it's actually quite fascinating to see that these companies exist. Her first opening message was that there is going to be, or really is, a trend to increasing for residents who move to the suburbs from the city. And I think this trend has really been taking place over the course of the last few years. I looked at some data from 2000 to, it's not on here, but 2000 to 2016. The rate of growth of residents in urban suburban and rural counties has been skewed to suburban at a 16% growth as opposed to an urban 13%. So it's probably more just an acceleration. We talked about acceleration of trends and deceleration of certain trends. So this is definitely something that's potential to increase. So for what she is seeing across the properties that they work with is on collections, a little bit lower than Brad, but about 93 to 94%, but similar to Brad, only about 3% of residents have gone onto a payment plan. So really quite low, actually. She was saying that the properties that they own in more of the touristy cities like Florida, for example, have been the hardest hit, with Louisiana being a little bit of an outlier due to the severity of the coronavirus outbreak there, and the resulting impact on the economy, of course, as well. She talked quite at length with her leasing activity. She did note that her renewals have in total have increased on a year-over-year basis, while the total activity of just the actual leases as opposed to renewal of existing leases has decreased. And what I wanted to look into further, but I couldn't really find too much information on this, was how much of a percentage of apartment unit inventory is actually leased on a corporate lease structure for, say, short-term rentals. I couldn't really find much data, but from what she's seen in her properties, there is a trend for the average stay of Airbnb to go to a longer term stay. About 1 in 7 bookings in 2019 was a longer term stay, and that's increasing. So kind of interesting. So I wanted to, this is my last slide, but I wanted to, I didn't include it here, but we were talking about rent growth and also collections earlier, and also in this section. So if anyone's not familiar, there's an organization called the National Multifamily Housing Council, and they're sort of the industry lobbying group, so to speak. And they have a rent tracker, and I'm watching this almost daily for any updates about like what collections are incoming to these properties. So the most recent data is from May 8th, and what they're seeing actually is an increase of 2% from April, which is interesting. So, and it's actually pretty much on par from last year's May. So what my hypothesis is that more of the stimulus checks are coming in, and why it's increased over April is because a certain portion of those checks had not been received in April. So, but it really goes to show that, like, a lot of, at least in my opinion, a lot of the collections are being stimulus boosted, so to speak. So it's kind of, if that $10 trillion that Jay Scott and Ferris Misa were talking about actually does come to fruition, we may see a favorable rent collection trends over the next few months. But if it doesn't, then we may see quite a bit of a drop potentially. So I just wanted to bring that little outside tidbit into that. And I believe that is my next slide, and I'll turn it over to, I believe Henry is the next slide.
Okay.
Bowick, I'm sorry.
Before Bowick, I know it's 7 o'clock, but I do wanted to quickly throw a polls to the group, and just to kind of gauge kind of the temperature, so to speak, and how everyone is planning to invest in kind of what they're looking for, and for us, or what they're going to project what the market's going to turn. So it's kind of fun for everybody to quickly participate. So if you guys can go quickly, maybe fill it out, and I'll share the results at the end of the webinar. So while we're doing that, Bowick, take us away.
Okay, thank you. So can you hear me? I just changed a new mic, and also for some technical problem, I cannot see it myself. So probably I will need to try. So Henry can control that for me. I just assume that you can see the screen.
Yep. We can hear you perfectly. Good.
Okay, good. Okay, so because we always know that location is so important for real estate. So, and also real estate is always local. So I'm going to use some data in King County, residential and condo in King County, Washington, because King County is a major major county in Washington. So on the screen, you probably will see that I will use the MLS data, the pending sales of residential property and condo. On the screen, you will see that over the past 5 years, the trend is kind of, I would say almost consistent, because some of the year may be higher, but some of the year, but the pattern is similar. So go to next slide.
And just also for the audience to know, we're picking King County as a representative, and also BOA has tons of data from King County, but it may be reflective of other tech hubs or maybe not. But I think that's like one great data point. There's a lot of parallels, I'm sure.
Oh, thank you. Yeah, because actually I prepare this for a presentation for my real estate agent later this week. So the next slide, although I cannot see the screen, next slide you see that there's a trend. Normally the pending sales, the demand is low in January, and then they will keep increasing. So majority of the, I would say most of the transaction actually happen around April to June. I mean, yeah, June or July. So that's the majority of the transaction happen around that. So go to next slide.
Yeah. Okay. And also, this is for residential property, so we kind of always want to bounce back between commercial and residential, because we are the investor in one way or the other. So good to share that information. So we're in the third slide.
Okay. So next slide, I assume that this one actually is the average. So the average, I put those, I make those 5 years as an average. You can see the similar pattern. So the demand of closing actually is a special pattern, increasing from January to the middle of the year and then drop again. So that's a consistent pattern. So let's go to next one. So on next one, you can see that compare the average, and also compare with what's happening this year, especially we are under the COVID-19 the impact. So on average, it's supposed to the pending sales should supposed to keep increasing February to March to April, but surprise, you can see that because of the the effect of this virus, the pending sales, the demand of the market of the the residential and condo actually dropped a lot March and April. So this one is a surprise figure here. And of course, you can say that it's not a surprise, because many buyers, they kind of stay at home. So that's why they don't have the willing to go out to buy more. So okay, let's go to next one. Okay, next one is we're talking about in the past few slides, we're talking about the demand, the pending sales, and then this one we're talking about the active inventory over the years in the past 5 years. Although you can see the yellow color, that is 2018, that year is kind of abnormal. We can discuss that a little bit more later. But most of the, let's go to the next slide. If you put it on average, and then I jump to the next slide too. If you put it on average, there's a pattern for the inventory. So the inventory keep increasing from January to the peak around September, and then will drop again. So that's the average. And then how about this year? This year, the inventory, you see the green color one, in the beginning of the first 2 months, the inventory actually is lower than average. But on March and April actually they actually go to almost similar to the average. Yeah. So from those lines, we know that the demand, the pending sales, the demand actually dropped a lot on March and April, but the inventory, residential and condo, the inventory actually remained almost the same. So what that mean? How that related to the price? Let's go to the next one. Yeah. So I assume you can see on the slide. I totally cannot see the slide. Okay. So this one. This one I combine the inventory and pending sales together in the same slide. The red color is the pending sales, and then the blue color is the inventory. So basically, you can see that the pending sale pattern, for example, in year 2015 to 17, the pattern of the pending sales are kind of similar, almost the same. But the inventory, the blue color inventory is not. I mean, the pattern is similar, but the amount is different. So because of that, let's look at 2016. In the first half year, the pending sales actually is higher than the inventory. And then because of, based on the demand and supply, become more demand than the inventory. So that's why the price here in Washington, in Kent County, 2016 is kind of crazy. And also 2017 have a similar pattern. Most of the time in 2017, the pending sales, the demand is higher than the inventory. So 2016 is kind of crazy year in the real estate market, residential. Let's go to the last one. Next one.
Yep.
Okay, next one we're talking about 2018 and 19. You can see that, the first few months, January to May, the first few months, the pending sales actually is higher than the inventory. I personally see that one of the transactions, I think they closed around March or April 2018. The listing price is 800,000, but they receive, I think, more than 14 bid on their property, and then the final selling price is 1.17, so much higher than the listing price because the inventory is not enough. But 2018, the second half year, the inventory, the inventory keep increasing. Demand is not that, the demand that keep a similar pattern. So because the inventory is more than the demand, so the price on the second half year of 2018 slow down, become more weak. In 2019, most of the time in 2019, the inventory is more than the demand, the regular. So last year, the market here is kind of okay. They are not, it was not crazy. How about this year? This year, you look at 2020, in the first few months, actually the pending sales, the demand actually is higher than the inventory. So although because of the pandemic, many people, they don't want to come out to buy. But in the beginning few months, I also see the market is kind of hot. Especially for those price less than $1 million, I receive a lot of a purchase and sale agreement. They involve a lot of bidding on those few months. So one thing so surprised is, on April, you see the red color on April. Suppose the color, the demand should keep increasing, according to the pattern. They should keep increasing to around 4,000 something around April. But on April, the demand actually dropped a lot. But the inventory keep increasing the same, the same pattern. But because of this, so this month is going to be interesting. So I long to see the data this month, at the end of this month, to see how that affect the market. If the demand keep dropping, but the inventory keep the same, then the market here will be, will drop the price normally. Yeah. So probably this time next month, I'm going to update the information to share with you. So that's it for my presentation.
Thank you, Boy.
Thank you.
Yep. Yeah, I think there's a good chance that maybe prices are falling. I think I will skip ahead. We can discuss this chart, which is about price discovery in a future presentation. We will be having another one in 2 weeks. Yan, do you want to do yours, or you want to?
It's okay. I don't mind. Yeah, whichever you want.
It's up to you.
Then I will just go ahead because it's a very quick summary. I will take maybe 2 minutes to summarize what Berkshire Hathaway annual meeting is about. So basically, Warren Buffett taught us a history lesson and told us not to bet against United States in the long run, especially this year compared to 2008. Fed did a phenomenal job by providing short-term liquidity into the market at much quicker than 2008, and overall the banks are in much better shape. That's why 3 out of his top holdings are in large banks. However, in the short term, no one can predict the market and anyone can make mistakes. He admitted that he made a mistake by buying airline stocks at the beginning of March and quickly realized that the whole industry might be permanently changed by COVID-19. Then he sold all his airline stocks and then realized a huge gain, a huge loss. Since anybody can make a mistake, he advised not to over leverage. On the other hand, also a lot of people criticize him for being overly cautious by sitting on a pile of cash and not buying back his own stock or investing in something else, which resulted in underperformance compared to S&P. So his comment is that as individual investors, you should buy S&P. If you're ever interested in buying single name equity, he said Berkshire Hathaway might be the best that you can find. On the other hand, he's not buying back his own stock or investing other investment is because he doesn't think they are attractive enough. He's holding cash and waiting for the next good opportunity. This might or might not come. That's it.
Great. Yeah, I know it's kind of a national holiday, at least for some investors, for the annual shareholder meeting. So a lot of people get very excited about it. So yeah, great to hear your takeaways from that.
Yeah, never bet against America, right? Hopefully we ended a more upbeat note. Thank you, Yan, for
we need some of that.
Awesome. So we do have the references, so we will be sharing this presentation to all those who registered, and we'll be able to also see the playback of this video. And lastly, we will be having another Coast-to-Coast meetup tentatively on May 26th, 2 weeks from today, at the same time. We don't have a Coast investing meetup yet. Oh, but while I'm talking, I want to share the results of the poll with everybody, so you can kind of look at that. Very interesting data. Looks like somewhat pessimistic for the short term. Lots of people holding cash, which is I'm one of those, but I can fill this out as well. All right, for everybody to take a peek at that. And also you can find our contact information on this page, and please go to the Facebook group because we'll be talking, and just be active there and sharing data. So you can find us there as well. With that, I think we are at the end of the presentation, and thank you so much for everybody to staying with us, almost an hour, 20 minutes. Any other panelists have any final thoughts, or want to have any questions? Or how do we interpret the poll results?
I think most folks see a downturn for 12 to 18 months.
Yep. Oh, it looks like we have an audience raising a hand, so I'm going to be switching to Pradeep. So just, all right. Pradeep, you can unmute yourself. You want to speak your questions?
Yeah, this might be a little general question. I'm already hearing like a lot of companies like Lyft, Uber kind of companies letting go of their employees, like 35 to 40% of the companies kind of getting slashed, and some businesses are like shutting down for good. How do you see this job market influencing housing market?
I can take that. I mean, we've been seeing a lot of layoffs starting even in the tech industry here. Locally in the Silicon Valley, I think Uber is letting off people, Airbnb's laid off people. But at the same time, I do believe the absorption will be better than 2008 or the dot-com bubble, because folks like Amazon and other tech companies, which are sort of more benefited by the virtualization, they might absorb a lot more. But in the short term, you will see some pressure on prices, more in the single family side, because they are not able to go out and buy homes. And as Bowick pointed out, in King County, the number of the inventory is slightly higher than what the demand is. So there's definitely some some upside pressure on the single family market locally.
Thank you, Vivek.
Yeah, I think coming into this recession, I think the housing market is actually relatively healthy. There's not a whole lot of over leveraging, but I think as people losing their jobs, it will have an impact. So we will remain to see. I think Neil's comment was maybe single family property for prices anyways are not going to drop as significantly. But I also saw from the NWMLS data that BOEC has for properties that over $1 million are going to affect more. Obviously, different markets at different price range. In Silicon Valley, that's a lot of houses that are over $1 million. We see here in Seattle that the inventory are going way up for $1 million property, whereas this demand is dropping a lot. So I think those properties are going to hurt the most. But then different markets are different. Maybe some in the Midwest and certain markets they're relatively healthy since we have had an affordability crisis for a long time.
It's interesting just to add a little color to that. So in San Francisco proper, the city, and then where I live, which is just over the Golden Gate Bridge in Marin, the homes, maybe a little bit more than $1 million, but not like say, whatever, $1 million and over. Those are remaining pretty strong. But if you look at like the data on the, in terms of listings and all that, it's all dropped, but they're all off market. But it's not really off market because there's literally like membership sites that you can join to like see all the off market listings. It's like off market MLS. And those agents are all pretty busy. So, again, to my comment about, things being hyper local, I think that's true. And also, gosh, I'm forgetting maybe it was Vivek. Yeah, it was Vivek talking about how the, COVID, it's like a stone that's dropped in a calm, a pool. There's all these reverberations that are going to take place. And so, people who own $1 million+ homes aren't necessarily in the service industry, et cetera, but at some point in the kind of economic, value chain, they will be impacted. And if that point in time happens, then of course, we'll see some dramatic effects in real estate, their homes, et cetera.
Yeah, good point. Yep. All right. This almost 7:30, so I think everybody, thank you so much for all the panelists and everybody who's staying with us. So we'll be talking to you guys next time in 2 weeks.
Thank you, everyone. Good night.
Thank you, everyone. See you soon. Stay safe.
Yes.
Thanks, everyone. See you soon.
Thank you.
Bye.
Bye. Bye.